The economic survey tabled recently has projected a real GDP growth of 8 to 8.5% in FY23, assuming that oil prices will average $70 to $75 per barrel in the next financial year. But that doesn't seem to be happening. The price of Brent crude oil crossed $96 per barrel on Monday amid fears of a possible Russian invasion of Ukraine, with the US saying such an invasion could be imminent. However, it dropped to $94 a barrel on Tuesday after Russia's announcement that it is withdrawing some of its troops from the border with Ukraine in a possible de-escalation of tensions between the two countries. Amid all this, India's retail inflation rate accelerated to 6.01% in January, breaching the upper tolerance limit of the Reserve Bank of India after a gap of 7 months. And for the 10th month in a row, the wholesale inflation is in double digits, coming in at 12.96% for January. The rural belt was worst hit as the pace of price rise touched 6.12% from 5.36% in December, while in urban areas it was 5.91% in January, marginally up from 5.9% a month earlier. According to experts, higher edible oils component pushed food inflation, while clothing and footwear inflation also soared to 8.84%, up from 8.3% in December. Economists have warned that rising oil and food prices pose a risk to inflation. But RBI Governor Shaktikanta Das said the central bank's retail inflation outlook for FY23 was quite robust. The RBI has projected average retail inflation of 4.5% in FY23. Das reiterated that inflation momentum was on a downward slope and the central bank had taken into account all scenarios. India is vulnerable to fluctuations in oil prices as it depends on imports for more than 80% of its oil needs. Market watchers expect oil marketing companies to effect a sharp hike in petrol and diesel prices in March once state assembly elections come to an end. Fuel prices have remained unchanged for more than 3 months now, despite a sharp uptick in crude prices. An RBI paper from January 2019 said that if a crude price shock hits the Indian economy, the current account deficit to GDP ratio will rise sharply irrespective of a higher GDP growth. And a $10 per barrel increase in oil price will raise inflation by roughly 49 basis points or increase the fiscal deficit by 43 basis points as a percentage of GDP if the government decides to absorb the entire oil price shock rather than passing it to the end users. Economist Madan Sabnavis explains the impact of soaring oil prices on government finances.
So the crude oil price is now moving towards the $100 mark, and I think there are expectations that it could also go towards the $120 per barrel mark. The budget has not made any provision for the prices going up, which means that in case there is the likelihood of the price going up, say above $100 per barrel, the price of petrol and diesel goes say to 120 or 130 rupees per litre post the elections. Will the government really be in a position to lower the excise duty any further? To my mind, such a provision has not been made in the budget. So it does look like that the government is counting on the crude oil price remaining fairly stable. And there's no provision made in terms for cutting the excise duty. The second part is that in terms of the RBI's policy, see, the RBI has taken a rather benign view on inflation, saying that inflation is going to come downwards and probably go below 5%. And therefore, they have retained their initial target of saying that we need to control the growth process. When they say control the growth process, try and make sure that the GDP growth remains resilient and is what they call durable. So the question is that will the RBI still be in a position to ignore inflation in case it shoots up on account of crude oil price going up and the government's inability to lower the excise duty in order to counter this increase? I think that will be the major thing to look out for during the course of the year, especially in the next few months, where it looks likely that this number of 100 will be breached and we could actually be looking at a number of $120 per barrel. So in short, I think what this really means for us is that we may have to live with higher inflation. The current account deficit will also come under pressure. We will also see the government having to take certain hard decisions in terms of the excise duty rate. And if the central government doesn't do it, I think the onus will fall on the states to lower the VAT in order to make sure that the consumer is insulated. from it. Otherwise, both the WPI as well as the CPI will continue to move in the upward direction. And say a $10 or a 10% increase in the crude oil price can actually push up the overall WPI by at least 1 to 1.5%, given the direct and indirect implications. And if you look at the CPI, we could think of something like 0.4 to 0.5% increase in the CPI on account of a 10% increase in the price of crude oil.
The government is hoping that crude oil prices will come down over the next few months, so it won't be forced to cut excise duties to rein in inflation when oil companies pass on higher costs to customers. Given the budget has not made any provision for a cut in excise duties, in case crude oil prices remain persistently high, both the RBI and the government will find themselves in a tricky situation.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.